All right. So inflation, right? Every time it gets brought up, what happens? Uh, People start to, you know, they start to panic, and we start seeing stocks selling off. All of a sudden, everything is just a big red mess across the market. So I guess one way I would really like to uh, jump things off here is you know let's understand one key thing. um, when it all boils down to it, fundamentals is what's going to matter the most when the market is going in a downward direction, right? This is what determines resilience and recovery in the stock. Um, the question is always, can the support hold? Is the stock gonna see a quick recovery and make its way um, back to the upside? uh, Listening in on different conversations today um, across the market, two things became apparent to me that the economists and the analysts are doing everything in their power to be right about their projections, but doing very little to prepare the economy and individual investors for these events. Um, Definitely is not surprising. The S&P 500 is performing well. It's been trading above its 50-day average for the better part of the previous 12 months. And this move is fueled by uh, extremely bullish earnings projections and overly optimistic fund managers. Um, these people have really forgotten what fundamentals is all about. Um, it is scary. Um, Look at the Q1 earnings, for example. 86% of companies beat their earnings by 22% or more. The previous average was 14.5. And that shows that there was bound to be a hard correction, not only in the stock market, but throughout corporate America. Um, Prices are not just increasing for consumers, right? So that's one key thing to keep in mind. But they're also increasing for publicly traded companies as well. So as cost increases for them, right, across the producer price index, then that's going to lead to an increase in pricings for you, right? Because these guys are going to need to compensate, right? So all of those companies who benefited heavily from the consumer-based inflation and the increased money supply, they're going to end up back at square one. They're going to be wondering to themselves, like, how are they going to increase their earnings now, right? Because, you see as inflation goes to the upside, then interest rates are sure to follow. We have the representatives of the Federal Reserve who suggest that they will definitely hold on as long as they can as far as increasing interest rates. But it seems like it doesn't matter anyway, because people still keep running in and out of stocks, right? Now, here's how it happens, right? So your producer price index, right? That spikes. This helps to fuel some of the corporate earnings and gives some companies the ability to boost their profits early. So these are the companies who increase prices on other companies, right? This is business to business type of deal, right? So you see that increase in pricing first, right? Let's take a look at this really quickly here. So let's take a look at this here. So as you can see, US wholesale prices continue to rise in March, adding to inflationary worries. In March, the wholesale price index jumped by 1% on the seasonally adjusted basis reported by US Labor Department. Crude petroleum prices continue to trend higher by 11%, preventing consumers to spend more money on other items as fuel costs are one of major household expenses. Over the past 12 months, the PPI grew by, that's the producer price index, right? Grew by 4.2%, led by increase in crude petroleum prices by 90.6%, right? So they've had a 90.6% increase in crude oil costs, which is why energy just keeps running. But this is what they keep doing though, right? Like they keep pumping up the market in areas where they see something going on, and then they wonder why they get smacked. I mean, it's this is what people are doing, right? Well, man, let's take a quick look at this though. Let's see what we got going on here. So let's start with this, right? So crude materials prices continue to grow, right? So this is your producer price index, right? Final demand services are up 3%, right? So you can see prices increasing and decreasing. Look at this. Fresh fruits, prices were dropping like crazy in November and December, right? Look at this. February, they came back a little bit. March, hey, not so much. So you can see this is a pretty, this is a pretty volatile market a little bit, Hey, if you're looking to start a business, this is a good place to look as well. This is passenger cars, you got all kinds of different things here that you can look at. Household furniture pricing grew by 2%. So all kinds of different things to look at. And then you have your consumer price index, right? The CPI, and this is how you gauge inflation, right? So prices increased on the faster pace, again led by increase in gasoline prices. So you see it affects both areas, right? So on a corporate level, right, and on an individual level, we're all affected by this right here. The consumer price indexes increased by 0.4% in February on the seasonally adjusted basis reported by the US labor. CPI advanced by 1.7% for the year. as the core rate increased on the slower rate than total consumer price index. All right. So we'll talk about all that in a second here. But so this follows its suit, right? So we first see the pricing over here that increases, and then we're here, right? So now they have the increased cost on us. Some of that increased cost is passed on to the consumer as the companies they look to compensate, right? Now consumers and corporations react by spending less next, because inflation, that's going to rise and spending is going to decrease, right? Consumers and corporations, they're going to start spending less. Then earnings are going to fall and stock prices are going to drop, right?
Don't mind, can I ask a question?
Yes.
Okay, so I'm on Twitter.
Mm-hmm.
How are we following again? I don't see the link here.
Are you close to your laptop or your computer?
I'm on my laptop.
Do one of y'all think y'all can forward Lulu that link for me?
Yeah, I'll send it in the chat.
All right, gotcha.
Yeah, that was, I didn't want to interrupt you while you was talking, but I have the same problem. Like, I'm not really following. Like, I'm on your Twitter page. We go to the inflation is not the problem. Stock or profit.
It's like a slide. It's like a slideshow, Nate. So you gotta, right now we're on page 3.
Page 3, okay. Let's on a different conversation. So we are.
So we're actually on our way. We're headed over to page 4 on the slide now.
Okay, I apologize.
All right. No, not a problem. Not a problem. So now, let's continue here. So what's the lesson to be learned here, right? So, and I think this is something that we really got to think on here, right? So people always talk about a low interest rate environment, and they talk about it in terms of stocks, a good amount. And here's the lesson to be learned here. Low interest rate environments are meant to finance the economy and end recessions. They're not here to increase the price of a stock, increase earnings estimates as a result of the increased money supply is what drives the stock price. Right? So if you're overvaluing a company in these kinds of times, that can lead to great losses when the market corrects itself, like we're seeing right now. Right? There's ranges. You got the stocks that are down less than the 1% in a time like this. You got the stocks that are down 2 to 5. You got the ones that are down 5 to 10. You got the ones that are down 10 to 15. A few of them are going to hit down 20, right? This is super important to understand. This is an economic environment, right? And not the capital markets. This is just these are just indicators of what's to come across the market. You have a question, JR?
No.
Okay. Does anybody have a question right now? Okay. On the next slide here, here's what we see. We see the effects of rising interest on earnings. Okay. We had a conversation about this before. We spoke about this. We spoke about how the PEs were too high, right? Who remembers that? Who remembers that conversation? Right? We spoke on this, and now, um, you know, now we see, we get to see it in action, right? Um, we said there's only two ways for a PE ratio to come down, right? There's only two ways. What's that? So yeah, so we said there's only two ways for a PE ratio to come down. And so, one of those is going to be for the earnings to decrease. The other is going to be that the price does, right? But one way or another, when interest rates hit, right, or coming down, most people will just project that earnings will be lower, or the earnings themselves will prove that to be true in these times, because now there's going to be less spending. We've already shot prices through the roof, and in order to cut all of that off, because these companies, they'll just keep coming with, they'll just keep building, they'll build up as much debt as they can sometimes, because we're in a low interest rate environment. So the government will say, okay, look, we're going to affect a new rate in this particular area, whether that be lending, credit, whatever have you. You know, they'll change the interest rate. They're saying they're going to hold off on it as long as they can, but I mean, we'll see. We'll see what happens. I personally have no expectations. So here's what we see though in a low interest environment. So we see that we had historic earnings, right? Ahead of Q1 earnings, analysts were already, they were already calling for a, higher than average beat on earnings. Historically, barely 6 out of 10 companies beat earnings estimates, right? But we got 80% that are beating now. So that tells you how much, how much money they're really borrowing, and how much these prices are increasing across the board to help them, build up on what they're doing. Now, we'll see, expected beats on earnings reports, led to a ton of people buying stocks and companies that they wouldn't have touched otherwise as well. Whether it be through, a lot of people just bought from FOMO because some of them companies was taking off, a lot of them just, just happen to follow the momentum and take a ride. Now, when those predictions worked out, so there wasn't much for, there wasn't much higher to go from there, right? So we end up seeing that most companies that beat earnings, some of their stocks were still falling, right? That's because the earnings growth was already, so you keep hearing them saying it's baked in. So 90% of stocks on the S&P 500 traded above their 200-day average for over 25 days. Right, that's 90% of them. So despite beating their earnings, they kind of had nowhere to go. We did some evaluating the other day. We did some calculating, right? What did we notice? These companies are already trading at these prices, or they're very close to it. From what I saw, about 75% of the companies that I revised were already, sitting at or above their projected prices. Like they were literally already there. So, it's kind of what you see going on there. Now, the downside here is that, of course, we're seeing increased inflation, right? The highest since 2008. So we saw a lot of those quick gains got erased. And now the S&P is only up 10.5% on the year. And as we saw earlier, our consumer price index at a 4.2. Now, these are the things that you generally see on your consumer price index. Right, so you have your household, right, your housing, your apparel, transportation, food and beverages, right, medical care, education, recreation, and other services, right? Now, if you notice, they don't put gas on this list. Normally, they wouldn't put food either. They would count everything else but gas and food. The inclusion of everything, we call it headline. So, this is when you absolutely positively have everything accounted for, including like the major spike in oil prices that we just saw, and now we're all having to pay more at the pump. So these are the key things that are going to matter right now. All right, these are your key things. So the first thing here is we've got to make sure that these companies are not overvalued at the moment, and we've got to be making sure that their debt is covered in several ways, that they have working capital, right? These are some key ratios that we can use. Everything that we're looking at here is within the financial statements. We were speaking about this the other day, return on current liabilities. We have Apple pulled up right now. A lot of our information is right here at the bottom of the page. We have our total cash. We have our total debt, our revenue, our net income, right? We also have our free cash flow per share right here, okay? Our cash from operations, long-term debt, right? Our current ratio is here. And so with these numbers here, we can calculate pretty much anything that we want off of this list here. If we wanted to do a return on current, liabilities, or return on liabilities, so we see we have our total liabilities here. And let's see what else we got going on here. This is our total debt. Okay. So if we were to take our net margin here, right, and divide it by our net, our total net debt, right? So I'll do that math really quickly. Let's see what we got going on here. All right. So we've got 76.3 billion divided by 121.65. And so our return on current liabilities or debt in this particular case is about 62.7%. Right. And so you would ask yourself, you know, am I satisfied with that? Is this company getting enough of a return on their current liabilities? Are they getting enough of a return on their debt? And so if somebody can, let's just say, essentially borrow, you know, they've got $100 million in debt, and they're able to net $60 million in a year's time, I think that you know, that's decent coverage, and I'm sure, you know, they would have other ways of also paying off debt, as we're not talking about other assets that are due to you know, other assets that are due to be converted into cash on a quarter-to-quarter basis as well. Okay, so these are the things that we want to make sure that a company's got going on. We've got our working capital here. You can go to the cash flow statement, and within the cash flow statement, you would be able to see our working capital right here, right? As you can see, right? There's been a decrease in working capital here, but an increase in free cash flow here, right? So the company, essentially, we can tell they likely took on some more debt, and they're you know, they're using that to increase cash flow at the company. And they're doing research here, as you can see, their capital expenditures. Yes.
So D is so capital expenditure is hold on, capital expenditure. I'm sorry, hold on one second. Can you go back to the screen you was just on?
Mm-hmm.
All right, so
let's go back down here.
Yeah, so the change in net worth capital. So you're saying that that's pretty much investment. Is that like the same as investment activities and net capital expenditure is research and development, or is that just completely different?
Wait, repeat that question for me then.
Yeah, hold on. So, all right, so the change in net worth capital, is that relative to, you know, how some cash flow statements that say investing activity or cash, you know what I'm saying, like cash flow from investing activities or research and development, is that what that is when you compare and change the net worth capital to net capital expenditure? If that makes sense.
Yeah, so net working capital is essentially, so you think of how many assets a company has, and how many liabilities that company has, and you're simply saying, what do you have left to work with after you've taken care of all of your liabilities, right? What do you have left to work with? So remember, we're talking current assets. So these are all meant to be converted into cash. So let's say they have an inventory stocked with iPhones, for example. This is stuff they plan on turning into cash within the next 12 months, right? So this is what we're talking about there. As we're speaking about capital expenditures, that's going to be more of your R&D type of deal. Plants and equipment and things of that nature. Does that answer your question?
Yeah, most definitely. I appreciate it.
All right. Let's see what we got going on here. So yeah, and that's you just kind of just make sure that you're doing all of your research, as I mentioned, on Seeking Alpha. All of everything is here. Our ratios, profitability, right? We got all of our profitability ratios here. All right, EBIT. I don't use it, but you can. I mean, there's nothing wrong with EBIT margins. Gross profit margin, slightly low, as you can see. So we get to really see what's going on here. Cash from operations, 77,000 times the sector median. Ridiculous cash flow. So return on equity is here, right? And return is basically your net margin in relation to anything, right? If you wanted to know how much a restaurant was making in relation to how much mustard they buy. I mean, just, same thing, same equation. Take whatever they net and divide it by how much that mustard costs. That's it. You're essentially using the same, anything that you want to know what the return is. Same formula. Let's see what we got going on here. All right. So as you can see, our total current assets are here, right? So you can find everything. This is our balance sheet right now. See our total current liabilities here. For banks, it'll be different. They'll have deposits there. Deposits are their liabilities. You would use that as their liabilities. If you're dealing with an insurance company, for example, then they'll have their insurance plans or whatever they got going on. So same, but again, same equation, just don't all overcomplicate it. You keep it simplified. Liabilities are liabilities. It's just how how different are one company's liabilities to another. So let's talk in other news though. Your boy Elon Musk said Tesla has suspended vehicle purchases using Bitcoin. I thought that was interesting today.
It went to 46,000 after he said it.
Went to 46,000 after he said it.
Yeah. I was in a room, people were freaking out.
Yeah, Doge was dropping at the same time. It was super interesting. So he does a poll to ask people, should he allow folks to buy Teslas with Bitcoin, with Dogecoin, and everybody's saying yes. Of course they are. Now, we always talk ETF inflows, outflows. You guys know I'm keeping my eyes on what's going on in the ETF space. So I know the market is crazy right now. So one way to gain growth in a more stable way is to simply buy into a total market fund, right? Or a highly diversified ETF. Yeah, somebody had a question? So for those of us who don't know what a total market fund is yet, it's essentially a ETF that covers like a large portion of the market, right? I mean a large portion. I've seen total market funds with over 2,300 stocks in them. It's craziness. So Six Meridian added a new quality growth ETF yesterday. Its primary focus will be to offer capital appreciation. The strategy is focused on owning a quality piece of the growth market. U.S. companies with above average quality and growth characteristics after screening out micro caps and companies with low levels of liquidity, similar to those ratios we just talked about. All right, make sure they don't have any, So you see, this is so based on what you just saw here, this is what the fund managers are doing right here. This is what the fund managers are doing right there. Move the micro caps aside, right? Stick with the stable companies, billion-dollar brands, right? And make sure that you always check that liquidity, check how well can they handle these finances right now. What's going on with all this right here? All this matters, right? For sure. Now, so definitely, I think we covered a lot. Blink your mics if you learned something tonight so far. Okay. Does anybody have any questions?
I got a question.
All right.
With as far as like buying stock prices dropping, when would, like, say a stock like Apple, when will we buy something like that?
You said when stocks are dropping, when would you decide to buy something like Apple?
Right, because do we just look at the value? I mean, not necessarily Apple, but any stock. So say a value stock, or the value stocks really dropping.
Got you. Yeah, the value stocks are gonna drop too. They're gonna drop too. Everything's gonna have its time in the mud anyway. So the first thing I would say is this, right? For sure, even though we use Apple as an example, just remember, for me, I'm never telling you what to do with your money, right? The key thing is, do you like what you see from Apple? That's going to be the first thing here. The second thing is, identifying what is going to be your entry strategy, You know, are you looking to make a play with options where you're looking to just ride the stock up? Do you want ownership of the company? What is it that you want? That's the first thing you start to think about. If it's ownership that you want, you know, I mean, the key is going to be to just average your way in. You know, you should never invest everything all at once anyway. You know, so you would want to just average your way in. You know, a company like Apple has a strong trading pattern, so you know, it's definitely going to find its bottom a lot faster than some of the other companies. The key is to wait for confirmation that it's coming back to the upside. And you know, if you're, you know, like, the more experience you become at doing it, of course, you know, you sometimes you can see it coming early. You might get in a little early, you know. But you know, in times like this, these are great buying times, you know, because I mean, you don't know the next time you're going to see Apple at 121, right? You don't know the next time. Before you know it, it could be at 145. You don't know, right? Um, so you know, that's just the key, man. The key is really just understanding that, you know, you definitely want to make sure that, you know, you're identifying the reversal and that you're waiting for your confirmation to get in. Make sure you're using those long-term charts, right? You know, don't want to get caught with a fake out in the middle of a day and then end up down for the next 48 hours or so, you know, trying to figure out how to, you know, how to maneuver the situation. So definitely make sure you're using your longer term charts for confirmation as well. You know,
All right, thank you.
not a problem, not a problem. Do we have any more questions?
Yeah, so you were saying earlier, the higher, or I'm sorry, the lower the interest rate. Let me go back to the question. So the lower the interest rate, that has an effect on lowering the price to earnings ratio.
No. So traditionally, we see that when our interest rates rise, our price to earnings falls, right? And that's typically because earnings will decrease, right? They're hyping up this earnings season right now because that's the only way to get us truly excited about buying. You know, they talk about earnings being all the way up here. You know, and price earnings is increasing because, I mean, we're talking about increasing a stock price by $2. I'm sorry, an EPS by $2, and you know, individuals literally buying into a company with a PE out of this, you know, out of the roof. You know, the stock price is out of here now for a $2 increase in earnings per share. You know, it's like stocks are increasing by 10 times to 20 times the multiple. Actually more like 30 times the multiple, let's be honest. And it doesn't make any sense, man. That's just what it is, though. You know, so like I said, man, the key thing for us is going to be just recognizing that this is what's likely to come, even though it's not here yet, right? If the Fed never increased interest rates, what do we think would happen? Somebody talk to me. What do we think would happen if the Fed never increased interest rates? You were going to say something, Jamarcus?
I'm honestly stuck right now.
Talking about like this.
Yeah, deflation.
Give me a second.
I think Tony might have some.
Yeah, he's coming up. Tony.
I mean, money would become worthless.
Runaway,
Tony is my hero, man. I
no.
want to be him when I grow up.
Yeah, okay. But yeah, you will see runaway inflation. Inflation's out of control right now. That's why Janet Yellen said they got to raise rates. But they can't raise rates. Their hands are tied. There's nothing they can do. This market is reflecting the fact that there's nothing they can do. And you're probably going to see, more sell-offs. I think Apple's going to hit 90 before it hits 140. And they're definitely doing a rotation right now. Now is when you're going to see the difference between professional traders and novice traders. If you don't know how to read your charts, if you don't know what you're doing when you're trading, this might be a good time to go sideline. This might be a great time to go sit on the sideline. I mean, today I came in, I played golf this morning, Duran. A buddy coaxed me into going out and playing golf at 7 in the morning. I came back for like the last, hour and 15 minutes of the trading session. And, I caught Oracle. Oracle bounced right off the 200. It bounced, couldn't go through, bounced, couldn't go through again, bounced. Tweezers formed right there. I just waited for that next bar. If that next bar encompassed that green bar, man, I jumped on it. Made $500 in the last 45 minutes of the trading session. And I played golf this morning. But you better know how to trade these markets. Am I a bull? Am I a bear? No, I'm an owl. I'm watching. I know what to look for. I'm looking for my charts to tell me what to do. And that's what you guys better get to that point, because it's going to be choppy going forward. It ain't going to be like it was last year where you can say, I just buy anything and it goes up. That's out the door. That ship has sailed. That train has left the station.
Yeah, I've been definitely sticking around that topic a lot, because that's the part that everybody has to be mindful of. I've been telling them, man, these picks matter now. These picks matter. They matter a lot.
Better know what you're doing. Better know what you're doing.
Do we have any more? Anybody have any more questions? All right. Excellent. So, Tony, man, I definitely appreciate you for coming up and bringing some clarity to that.
I was trying to hide. Right? I was sitting down there just listening.
Definitely. For sure. So now, definitely, of course, I appreciate everybody for, just, chiming in and getting to sit back and talk about what's going on with this environment that we're in right now. And I call it an environment because, that's just what it is. Just got to adapt to it. This market is definitely not smarter than any of us. It's built on a system. If you learn how that system works, you'll be able to, be able to maneuver and put yourself in a prime position to win. I will definitely look forward to talking more about it soon.